All right. Looks like we have some folks joining us today. So thank you so much for that. We'll go ahead and get started. Welcome everyone to Animal Protection New Mexico's webinar on holiday giving for Animals Simplified. We're so grateful that you could join us today to learn more about how to support your favorite charities during the season of giving with the most tax savvy and cost-effective methods of giving. This webinar is being recorded and you will receive a link to the recording. For those of you who don't know me, my name is Isabel Slater and I'm the Major Gifts Officer with Animal Protection of New Mexico. Today's presentation will be followed by a Q&A session. You can submit a question at any time during the presentation using the Q&A button, which is at the bottom right of your screen. Questions will be answered at the end of the presentation, or if our wonderful panelists would like to respond to them in advance, that is also totally up to her discretion. I am also joined today by Dorte Hutchinson, Animal Protection New Mexico's Chief Development Officer. I would like to welcome Dorte to share some information about Animal Protection of New Mexico for those of you who might be new to our organization.
Well, welcome everybody and good afternoon. Yes, I am Dorte and I am the the Chief Development Officer for the organization. And for those of you who may not be quite so familiar with Animal Protection New Mexico, we are a statewide nonprofit that protects animals by creating social change, resulting in the humane treatment of all animals. We create policies, infrastructure, and services that protect animals and strengthen the communities in which they live. We also design and implement humane solutions to seemingly unsolvable problems that involve animals. And in conjunction with our legislative arm, animal protection voters, we try to change the systems that actually harm the animals and demonstrating to the public and to policymakers that the wellness of our society overall is directly linked to the well-being of all animals. And with that, I'd like to turn it over back to you, Isabel.
Awesome. Thank you so much, Dorte. I will now introduce Susan Morrison, who is a financial advisor with Q Financial Planning and has generously agreed to act as our financial expert for today's webinar.
Thank you so much, Isabel and Dorte. For those of you out there, thanks so much for attending. My name is Susan Morrison. I'm a financial advisor with Q Financial Planning, and I've been a long time supporter of Animal Protection of New Mexico. As most of you know, I'm sure it's a fabulous organization. The work that they've done is really amazing. But there's lots and lots of really good charities out there that support many things that you may be interested in addition to supporting the animals. So what I want to talk about today is some options for you to think about supporting your favorite charitable organizations and doing so in a tax-advantaged way, in a way that's going to maybe give you a little bit of a break tax-wise. And there's 4 primary things that I want to talk about today. Charitable IRA distributions, gifts of appreciated stock or other types of property, donor advised funds, and charitable legacy income trusts. Now, we know that in addition to those types of gifts, there's lots and lots of other ways to give to charity through charitable gift annuities and charitable remainder trusts and so forth. But those require some special circumstances. And so today we'll focus on things that you could do between now and the end of the year to make your gifts. And so what I want to start with is the qualified charitable contribution, the opportunity to give through your IRA. And what I'm going to do here, sorry, I can't talk and chew gum at the same time. I'm going to share my screen with you and hopefully here in a minute, you'll be able to see kind of what we're talking about. So here's the scenario, right? If you are an individual who is at least 70 and a half years old, you are permitted to take some of your required minimum distribution from your IRA and donate it directly to APNM or another charity, another 501c3 qualified charity of your choice, and not have to recognize that income on your tax return. And essentially, let's say that you are a 75-year-old with an IRA that has a required distribution of $15,000 this year. And you have, you're fortunate to have maybe a small pension and some Social Security, and you do need some of that 15,000, but maybe not quite all of it. So what you might consider doing is something like donating 5,000 directly to your charitable organization, and then having 10,000 distributed directly to you. And that would then satisfy your required distribution, and you would report it on, you would receive a 1099-R for that distribution, and you would report it on your tax return as that for that $5,000 portion, taxable amount 0. So it's a pretty simple way to make a gift to a charity. It's a simple calculation on your tax return. It doesn't cause a lot of extra forms or anything like that. And you simply tell your investment company, whether it's Fidelity or Vanguard or whatever, you just have them send the money directly to the charity. So it's a pretty nice deal. It's really for people who are 70 and a half and older. So if you're not quite there yet, hang in there. There's some other gifts that we'll talk about that will work for you. And so if you are at least 70 and a half, or for some people, required minimum distributions start at age 72. If you are already taking those required distributions, then you know what I'm talking about. And you might have, let's say, a rollover IRA. You might have a SEP, an SEP IRA, or a simple IRA, or even still maybe a 401k or a 403b. Those are all kinds of pre-tax plans that require you to take that distribution at age 72 now, 70 and a half earlier for people who are a little bit older. However, there's a little bit of a catch here. If you are still contributing to your simple IRA or your SEP IRA, then that will not, you cannot use that qualified charitable distribution option. So it has to be a simple or a SEP that's no longer active, or a rollover IRA. And remember, I said you might have a 403b or a 401k. Well, this is a charitable IRA, right? And those things are not IRAs. So this does not work if you had a 403b or a 401k that you still had from an old job, or maybe you're still working. So it has to be from an IRA, and it has to be from either a traditional or rollover IRA, or from a SEP or simple IRA that you're no longer contributing to. What thoughts or questions? Does anyone have any questions about any of that, about the charitable IRA, before we go back to the next gift?
I don't see any questions yet. Just a reminder that everyone can submit them through the Q&A. And if you have trouble with that, you can always just chat me too, and I'd be happy to answer directly.
That's right. And if you still can't figure it out, and I'm very technologically challenged, so I'm really talking about what I would be doing if I were in your place, I would just wait until the end in the Q&A, and you can always submit your questions there as well. Okay, perfect. So that's the Charitable IRA Distribution Act. It permits you to give directly to a charity and not recognize it on your tax return. Okay, let's now talk about something that's a little bit different. And this is a little bit more involved, but this is the type of gift that might work for you if you're the type of person who wants to support multiple charities and you want to do so year after year. Or you want to support one or more charities and you have a big contribution that you want to make one time or over the next couple of years. And I'm talking about a donor advised fund. And I hope you can now see on your screen how a donor advised funds work. And so they make it look really simple with these fun little pictures, right? You make the contribution, you get the tax deduction, the money gets invested, and then you select organization to make grants to on whatever timetable you decide. And certainly upon your death, then the grants would continue to be made to those organizations year after year. So it's kind of like a little miniature endowment that you're setting up. And you can include more than one charity. So like I said, if you support APNM and let's say Animal Humane and let's say Prosperity Works, you would be able to support all three of those in whatever percentages you felt that you wanted to do. So these donor advised funds are now available to people with relatively smaller upfront contributions. Typically, they require around a $15,000 or $20,000 contribution to get started. And if that's a little bit too much for you, you can always do it over a period of time. They just won't start making the grants until the fund is, until the account is fully funded to their minimums. But it is a pretty cool deal. So you have your own little private foundation, and the cost is really low because these mutual fund companies are now running these. And what you do is you just set it at a company. And I've seen them at Eaton Vance, which is now running the Calvert, the socially responsible Calvert Funds is owned by Eaton Vance. The charitable Fidelity has a charitable gift fund. Schwab has a charitable gift fund. There are others, and of course, you could always use a community foundation, right? The Albuquerque Community Foundation. You can set up a donor advised fund there, or if you really, really want to support one charity in particular, you could set up a fund, for example, at APNM in their endowment that would be carved out for the purposes that you and they work out together. So it's a pretty neat deal. It's kind of like a private foundation for people who don't have tens of millions of dollars to start a private foundation. And the tax deduction that you get in this case is basically for everything that you've put in. So let's say you just contributed $20,000, you wrote a check to fund this, you would get a tax deduction for $20,000. But let's say, for example, that you bought some Apple stock 20 years ago, and you bought 500 shares because it was cheap. And now it's doubled and tripled and quadrupled, and the shares have split and it's worth a lot of money. And if you sell it, you're going to be hit with a big capital gain. So you might have only put, let's say, $2,000 into that Apple stock, but today it's worth $20,000. So if you sold it, $18,000 would all be taxable capital gain. However, if you just donated that stock directly to your donor advised fund, you would get a tax deduction for the full $20,000 and no taxes, because the fund itself is tax-free. So when the Apple stock gets sold inside the fund, it doesn't result in taxes to anyone, which is really the best case scenario. So none of your gift is reduced by taxes in that case. And then once the money's in the fund in this case, this particular piece of literature that we're looking at is from the Calvert Funds, and they invest in certain things for their for these types of donor advised funds. And as I said, the Calvert Funds has a line of socially responsible funds, and that's what they would use in these occasions. And then you just pick the organizations that you want to make grants to and the timing of those, like if you want it to be made annually, or maybe you want only, once every 2 or 3 years, so that the money builds up and it's a more meaningful amount going to the charity or whatever. And just a note, in terms of the contributions going in, I said, if you have a highly appreciated asset, it might be advantageous to just donate the whole asset. But imagine that you bought an asset, let's say you put in $20,000 and today it's worth $2,000. Unfortunately, there are a couple of those opportunities out there, right, where you end up losing most of your money. Well, in that case, you wouldn't want to donate the stock directly. You would want to sell it and take the capital loss, harvest that loss, and that's basically your tax deduction, and then donate the cash to the charity. So really, there's an opportunity for you for a tax benefit in either scenario, whether you have appreciated property or depreciated property. One more just quick note on that. A lot of folks that I've talked to have rental real estate. A lot of these folks have owned these properties for 30 plus years, 40 years in some cases. You've depreciated them all the way down to a zero cost basis. And if you sold that property, you would have depreciation recapture and capital gains and probably some additional taxes, and might end up paying 45 or 50% in taxes. So one option, of course, is to do a 1031 exchange and just exchange that piece of property for another piece of rental property or something like that. But if you're trying to get out of the rental business, then another option might be to donate that property to your donor advised fund. And let's say you have 2 rental properties, and they both have been depreciated down to 0. And they're just small residences, and maybe they're worth $200,000 each, something like that. You've been renting them for a long time, but you're kind of tired of it, and it's getting to be more of a hassle than anything. You could, for example, donate one of those rental properties to your donor advised fund and get a big tax deduction, $200,000, and then sell the other one. And instead of taking that incredible tax hit, you would have this big deduction on the one side to help offset the tax hit. And both you and the charity end up doing fairly well in that situation. You reduce taxes on the sale of one of your properties, and the charity basically has the value of the entire property to work with and invest and start making grants to the organizations that you care about. Any questions or thoughts about any of that before I move on?
We did have one question in the chat from Jimmy just about the slides and if it would be possible to share the slides afterwards.
Yeah, absolutely. I'm happy to do that. What I'll do is I will send these slides over to Isabel, and then you can pass them along to the participants.
Fantastic. That would be great.
Absolutely. Okay. All right. Wonderful. Wonderful. Okay. So now I want to talk about another giving device. And frankly, the donor advised fund and the next thing we're going to talk about, which is the legacy income trust, anyone can do these, right? There's no age limit or anything like that. Really, you just have to have charitable intent. You just want to have the desire to help someone, and you'll get a little break tax-wise for doing it. So the next thing I want to talk about is what's called the legacy income trust. And unfortunately, I don't have a very pretty graphic on this one, but I'll just kind of describe what it is. It's essentially just like what we talked about, that donor advised fund. You contribute property to this sort of trust. The minimum is $20,000, but you can put in obviously a lot more. But the difference here is that this is sort of like a charitable remainder trust. If you know what that is, you contribute money and then you take income over your lifetime. And at the death of the last income beneficiary, the balance in the fund goes to the charity. So that is a great tool, but it's really for people with a fair amount of wealth. And even the cost of setting up one of those trusts, you have to go to a lawyer who really specializes, and they're complicated and they have to be administered correctly. So this is a way that, and again, this particular company is Calvert Funds. Eaton Vance is the parent company. And they have something like a little charitable remainder trust. They call it this legacy income trust. And it works just in the same way, but it's just much cheaper and much more simple for regular folks to use rather than having this fancy trust. So here are what they call the benefits. Again, you avoid recognition of capital gains on contributions of appreciated assets. And that's really important because if you have, again, the example I gave earlier was some Apple stock. Well, a lot of people have stuff like that or real estate that has gone up in value. And so this is another opportunity to avoid some of that capital gains tax. You can reduce concentration risk without a tax event. What that means is, let's say that you have been working for Honeywell your whole career, and in your 401k, all you ever bought was Honeywell stock, and you invested in Honeywell stock, and now here you are retired or nearing retirement, and you've got 90% of your portfolio is Honeywell stock. And no matter how good of a company it is, you're taking on a significant amount of concentration risk by holding everything in one company. Because if something were to happen to that one company, the whole value of your portfolio could tank. And so you want to get some diversification, so you could donate a lot of that Honeywell stock to this legacy income trust and not have to worry about capital gains. And incidentally, if you still have that Honeywell 401k and you've already retired, you can always roll it over into an IRA, and then you can take advantage of the charitable IRA distribution. So that's, there's, if you have a 401k or a 403b and you're not still at that company, then you could certainly still use that mechanism if you're old enough. So you avoid recognition of gains, you reduce concentration risk. Importantly, you get the charitable income tax deduction. And that's based on the charitable portion. So here's the way these things work. Let's just give a little example. Let's say that you set one up with $100,000, and that represents a bunch of stock that you bought years ago with a huge gain, but you can't just afford to give it away. You really need to take some income, and you need income to supplement your Social Security income over your lifetime. And so what you might do then is name some income beneficiaries. And it might just be you or you and your spouse, but you can name up to 10 income beneficiaries. And it might be you and your spouse and your oldest 3 children, or your whole family, or all of your siblings. It's really up to you, but you have the opportunity to name up to 10 income beneficiaries. So the idea is that you put in this 100,000, money comes out year after year until the last of those people has passed away. And whatever's left, that goes to the charity. And so we don't want to wait until the last of the people has passed away for you to get your tax deduction. right? You want it the year that you make the gift. So what they do is they calculate the life expectancy of the income beneficiaries that you've named. So the fewer the beneficiaries, the higher the distribution is going to be, right? And the more the beneficiaries, the distribution to the charity at the end is what I mean. And if there are 10 income beneficiaries, then there's a statistically high likelihood that the amount going to the charity at the end is going to be less than if it's only based on one person's life. And so the charitable contribution, the tax deduction is based upon this sort of actuarial calculation of life expectancy. So back to our example, you put in 100,000, and let's say it's just you and your wife or spouse or partner that is taking income. And let's say you're in your 70s now, then you would probably get a pretty nice tax deduction, maybe 65%. And I'm just throwing a number out there. I don't know what it is. We'd have to actually calculate it, but it might be something like that, 65, 70%. If you name 10 people and the youngest one is your grandchild who was just born, then the amount that goes to charity is probably going to be much, much smaller, meaning your tax deduction will be smaller. Any questions about that portion before we talk about the rest of this gift method? Okay, great. So you've put the money in, you've selected your income beneficiaries and made their ages known. That drives the charitable tax deduction. So you've gotten that. And now you want to start getting your monthly distributions. And so the trust would just pay distributions, and they say tax advantaged because the way that the money is invested is for the most tax advantaged distributions. In other words, qualified distributions, which are typically taxed. So yeah, it's taxed as primarily as qualified dividend income. And that's important because it's at a lower tax rate typically than your regular tax rate. So tax advantage distributions, and the trust seeks to increase the distributions over time to keep up with inflation. And we all have seen inflation. It's rearing its ugly head right now, and it has been. And we've seen it in housing prices and building materials. If you've done any renovations, travel and vacation costs are up, gas prices, food prices, cars, both new and used, practically everything is going up. And so that's going to be really important that if you look to a vehicle like this, that you'd be able to have increased income over time. And that is a goal, to grow the account faster than the value of inflation so that your distributions, which come out as expressed as a percentage, will continue to be higher every year. And then at the death of the last surviving income beneficiary, the fund would make grants to the organizations that you select or that a donor advisor or designee selects. And that's really, the important part, to make sure that your dollars get to the organizations that you care about. Questions about that?
Susan, I guess I kind of have a question. This seems like a really interesting, option for people. And I just kind of wonder, besides the tax benefit difference, if somebody is kind of deciding between these two options, what kind of questions would you ask them to consider in terms of donor advised fund or a legacy income trust?
Well, it's really just the issue of whether you need income. Do you want income? It's the legacy trust. If you don't need income and you just want to make the contribution, the donor advised fund. And incidentally, when this legacy income trust terminates, it turns into a donor advised fund, right? Because that's really all a donor advised fund is the exact same structure where you're making grants to the organization. And so this could be, at the death of the last income recipient, it could be a lump sum to your organization, or you could continue, it could just continue making gifts every year in perpetuity. So yeah, it's really just about, can you afford to make the gift outright, or do you need to actually get some income off of this to, to cover your living expenses?
That makes a lot of sense. Thank you so much.
Yeah, absolutely. One other thing I just touch base on quickly is just a straight out gift of appreciated stock, or an outright gift to your charitable organization, one or more of that, let's say that that rental property that's gone up in value. In those cases, it's, it's a simple thing to transfer title to an organization or to the trust, and you avoid all the capital gains. These are a little bit more involved, the donor advised fund and the legacy income trust, because you have to like set up the fund with a company, and it's a little bit more involved, but it's not really a big deal. But you could also just make a straight outright gift, right? And just get the deduction for the entire value of the gift and not have to pay those capital gains or depreciation recapture taxes. Okay, so, all right, I have one other, or a couple of other just quick things that I want to talk about. There are still some advantages from the CARES Act. We all remember last year, any of us who are taking required distributions, remember that last year, no required distributions were required. You could take them if you wanted. In other words, you could leave all the money in your IRA, even if you were already 72, but you didn't have to. The RMD rule has expired. It was not carried into 2021, so people are now required to take those distributions again. But there is one thing that did carry into 2021 from that CARES Act, and that is, if you in the past, if you made a cash contribution to the organization or one or more organizations, then you were limited in what you could deduct up to only 60% of your adjusted gross income. And let's say that let's say you have a pretty small income. Maybe you have Social Security and some dividends from your accounts, but that's really it. And so if you made a big cash gift to charity, you wouldn't really be able to deduct much because you really didn't have much to deduct it against. But you'd be limited to 60%. That just through the end of this year, just for this month and next month, has been wiped away. So if you made $30,000, you can deduct $30,000 of giving. And so that's a nice benefit. And if you have carry forwards from the last years, it won't impact your carry forwards. It won't hurt them. You'll still have those carry forwards. So this is just an opportunity for people to make bigger cash gifts and deduct all of them up to the amount of your income, rather than having some of the limitations. So it's just a one-time deal that was just last year and this year, and then it goes away. Any questions on that? I feel like I covered that kind of quickly, and I'm not sure that was very clear. Okay, good. Just a few other things I wanted to mention. These are all ways that you can take advantage of tax, sort of tax advantaged giving between now and the end of the year. Cash gifts, stock gifts, gifts of real estate, things like that, either directly or through your IRA, or by setting up a donor advised fund or a legacy income trust. And these are all wonderful ways to make a big difference in organizations now. But another thing that you might think about is, particularly if you say, yeah, I'd love to be able to give $100,000, but I can't afford it, and I really need that 100,000. Well, Absolutely. And that's the situation that many people are in. And so in that case, what you might consider doing is just adding your charitable organization as a beneficiary to an IRA or a 401k or even a bank account, or putting them in your will for a gift is another fairly simple way. That's a little bit more complex because you have to have your will redone. But if you have a bank account or some kind of an IRA or other type of financial account, you could just name APNM or Animal Protection Voters or Humane Society or whichever organization you'd like. You can just name them as the beneficiary directly, and then that amount would go directly to them, not through your will. And you would then make sure that you had it available for your lifetime if you needed it. I think that's all I have for you folks today. Just to recap, charitable IRA distributions, gifts of appreciated securities or real estate or really any kind of property. The donor advised fund, where you just set it up, contribute to the fund, and then make grants to the fund, to your charitable organizations from the fund. And then the legacy income trust, which is kind of like the donor advised fund, but you take income for your life and up to 9 other people's lives. And then at the end, the balance goes to your charity or charities that you've designated. So lots of good options, most of them fairly simple. It doesn't require a lot of upfront giving, or upfront dollars rather. Up $20,000 typically to open donor advised funds or legacy income trusts. And I will say with absolute surety that APNM and any of the organizations that you support would be delighted to get your gifts in any amount. It's a tough time for charities, and so anything that you're willing to give would make a difference.
All right.
Isabel?
Thank you so much, Susan. Appreciate that. That was a really thorough overview and was super helpful, at least to me, in kind of understanding these ideas and making them seem a little bit less complex. Do we have any questions? Again, you can put your questions in the Q&A. If you wanted to ask a question live, you could also use the raise hand feature. So I'll throw that out as an option as well. All right, I'm not seeing any questions, so I'll just go ahead and say thank you so much to Susan, first of all, and to everyone else for joining. This was hugely impactful, and we're really grateful. As Susan said, this is a challenging time for all nonprofits, so we really appreciate that you're willing to give. We will share both the slides and the recording later on, and we hope everyone has a fantastic evening. Thank you so much.
Thanks, everyone.
Thank you.